You see the market going down, then you notice that it's beginning to pull to the upside, so you believe the uptrend has started. Then you rush to buy from a demand. Quickly identify a demand or support that you want to buy, because that's what the theory says, right? We buy from demand levels and sell from supply levels. And when the market finally pulls back into your demand, opening your buy position, the market suddenly just breaks down your demand and you panic because it invalidated your analysis, then shortly after it stops you out of the setup. But not only that, the frustrating part is that it even goes to hit the take profit after you already lost the setup. If this sounds similar, this is a problem most traders will find themselves into, and let's watch back and correct the mistakes that were made. First of, we can't just open a setup without knowing the swing points. So we must do a directional analysis of the swing levels the market has been forming, from each low to each high. So if we look at this price action, it's a downtrend. We know that because the highs had not broken to the upside, so in other words, we had highs that were lower than the last highs, and same for the lows. Being lower than the previous lows, they're called lower lows. The big mistake was done when we've seen this upside movement and thought the uptrend has started. But for an uptrend, we must have higher high formations on the swing points, something that we don't have. For a demand to become valid, the market has to break above the last high, creating a higher high, a thing that did not happen. So this demand is not valid, which instantly disqualifies a buy position from here. So we did not follow an uptrend, but instead it followed a downtrend. And this upside movement was actually just a pullback so the market can fill a potential supply from the last highs, which we did actually have. And it's from here where a position might have worked out better since we are trading with the flow of the trend instead of trading against it. So what actually happened is that the market was in a downtrend, and it continued the downtrend because we eventually got a fill of the supply that pushed the market down into another lower low, which is a formation of a downtrend. So this is how traders get trapped. Well, really, it's not even a trap. It's just about not properly applying the market analysis, which, by the way, you can look it up on the link in the description because we heavily focus on this lesson. But for now, let's move into another type of example. So remember that we begin with a directional analysis of the recent price action. This will help us know what are the swing points the market has been forming. For instance, on this market during the recent price action, we constantly created lower highs and lower lows. Then what came next? Exactly the same. It basically kept the bearish formation. But then shortly after, a huge bullish push kicks into this market. This actually broke above the last high, and even above all of the previous highs. Make sure to pay close attention to the swing points of the highs, because if we look from the left, as I said, it constantly had lower highs. But this upside movement created the first higher high. Now when the market was previously forming lower highs, so it was following a downtrend, but then we have the first formation of a higher high. The first break to the upside is a trend change from a downtrend into an uptrend. We should also look at the swing low formations. We had lower lows for the swing points, and now that we are in an uptrend, the theory suggests that uptrends have higher highs, which we already have one right here, that should be followed with higher lows, which we don't have it yet. But if we would, the higher low should many times end on a demand or support. So we just identify that level that should be on the last low. This would be the demand. Now we need some patience, and let's see what the market has to show us. So what happened is that we did got a pullback to the downside, but this pullback was not able to fill the demand, and the market then continued higher and broke again above the last high. The second break is not a trend change anymore, but it's a break of structure, which basically just means that it had bullish continuation. This continued into a new higher high. And essentially, if we validated a higher high, we can also consider this as a higher low. From a higher low, we identify another demand from where we look for the market to pull into this demand and bounce to the upside, unlike the other demand that it didn't even fill. This is how most would think. But this turns out to be a huge mistake, because the market breaks down the first demand. That means that it broke below the past low. So you would now think that this is a trend change into a downtrend since we have the first lower low formation. So now you invalidate the buy setup and you look for sell setups taken from a supply zone from the previous high. All that because you expect the market to be reversed into a downtrend. But what actually happens is that it drops into the first demand and actually respects that demand, bouncing to the upside. So the traders that entered buy setups on the second demand lost the setup because they ignored we had a valid demand below. And if we look at the continuation, basically what happened after that The uptrend continued since it broke above the last high. So you might have been right about the direction of the market, but you still ended with a loss setup because you ignored a higher priority entry structure, being the demand from below. So the right position would have been just as simple as being patient for the market to pull into the first demand from where we actually look to plan the buy setup, with the same targets: stop loss below the demand, take profit above the last high. Structurally, this would be a huge setup, a quite rare opportunity. So what you want to learn from this example is to be aware of extreme demand or supply levels, because the market might print more demand or supply levels above the first one. But a lot of times they will break just to fill the first one, which might be the one that actually respects, into another common mistake that many are still doing. So we start from the beginning with a directional analysis, which looks to be a downtrend, so to make sure we check the swing points the market has been forming. It starts here from a high, from where the market drops down into a low, pulls back to the upside but ends below the last high, forming a lower high. Then from this lower high we have another drop to the downside that breaks the last low, having a lower low. And now the market is pulling back to the upside if the market repeats what it has done. So essentially holding a bearish continuation, it should create a lower high. In other words, the market should not be able to break above the last high, and instead it needs to end below this high. So then the market can follow by breaking the last low into a lower low. So as I said, just holding a continuation. But we see that it breaks above the last high. And so as you know, when the market was previously in a downtrend and then it breaks above the last high, that's a trend change from a downtrend into an uptrend, since the market now created the first higher high. And what usually comes after a higher high? Often a higher low seen as a pullback to the downside, so it can later continue the uptrend that it just started. The uptrend is continued because the market pushes from a higher low into a higher high, and that higher low often ends up on a demand or support that was taken from the last low. So we place a buy setup from this demand and take the market into a higher high with the take profit. But what had actually happened is that it dropped down, filled the demand, and quickly broke it down, closing on a losing setup, and we actually had a lower low formation instead of a higher low. Why is that? Wasn't the market supposed to create a higher low on an uptrend? Well, it should, but if we closely look at how the market created this higher high, it is broke to the upside with a wick and not with a candle closure. The problem is that the market has to break above, which it did, but it has to do so with a candle closing above the last high. If that doesn't happen, and it just wicks to the upside, that does not show a valid reversal. In fact, it just shows that it tried to enter into an uptrend, but buyers didn't have enough strength. So be careful, because for a valid reversal into an uptrend, the market has to close above the last high with a candle, and not just wicks. We have lessons made to analyze the market in a proper way on the link in the description, and I highly suggest you watch more of our content. It's really complex, but explained in a way so everyone can understand. This video was more of a warning to be aware of the mistakes that I often notice.